They have given that they have a current ratio of 1.5, they have a quick ratio of 0.4, and they have a positive cash balance. Okay. If it purchases inventory on credit, what is the effect on this ratio? Okay. Effect, they have purchases inventory. Hmm. They have purchases inventory on credit. Okay. What is the effect on this ratios? That is the question. Okay. We will spend some time here. What is the formula for current ratio? We take current assets and we divide it by current liabilities, right? Quick ratio, what do we take? We take cash and cash equivalents. Hmm. We add the accounts receivables and we add the marketable securities. Hmm. And they have a positive cash balance. Okay. Uh, so they have purchased inventory. So what happens? Your inventory increases, right? Or we can take some hypothetical situations also. So say our assets is 100 and liability is 50. Okay. Or let's take 100 only. So we have, oh no, they have this current ratio of 1.5. So how will we get to that? Um, hmm, how will it come? 1.5. So if we make it 150, yeah, yeah. So suppose our, what we can do here, that we can say that okay, our current, or I will do a better presentation probably. We say that current assets we have, you know, 75, and then the current liability is 50. Then we say okay, our current ratio is 1.5. Let me do some alignment here. Yeah. So this we are saying that this is our existing current ratio. Now we purchase inventory for say 25. Hmm. So in the current assets, because of the inventory, what will happen? It will increase. This will also increase by 25, and then our ratio will come down. Hmm. Right? Because we are purchasing inventory here, it will in current assets will increase by 25 because we bought the inventory, which is a current assets, and because we have bought it on credit, our current liabilities, our payables will increase, and hence our current liability will increase. So now our new ratio is 1.3. So we can see there is a decrease in the current ratio, right? Quick ratio they are already telling is 0.4. So that means our cash equivalent, AR plus marketable securities, and then we divide it, didn't write the full ratio here, and then we divide by the current liabilities. Okay. So for example, um, we already have this cash equivalent ARNMS of 100, and then or maybe 200, and then our current liability is 50. Mm. Our ratio. Okay. So what should we do? Should we call it 20? Yes. So if our cash equivalent, accounts receivable and marketable securities all are 20, and we have this current liability of 50, our quick ratio 0.4, we purchased an inventory. So inventory will not increase this section, the numerator. Hmm? It is not part of cash and cash equivalent. It is not part of account receivable. It is not part of marketable security. So this remains the same. Okay. And current liabilities, because we bought this inventory on credit, our current liability will change, right? Our accounts payable will change, and then this current liability will change. So our new ratio will be even lesser, right? So this will also decrease. Hope that makes sense. If there is a, you know, uh, increase in the current liability and our numerator doesn't change, cash equivalent, AR, or marketable securities, you know, uh, this quick ratio will also decrease. So the answer will be the first one, decrease and decrease.